Good evening. Welcome to Money Matters. I'm Charlie Shields of Wells Fargo Advisors, LLC. My co-host tonight is Pat Welde, Merrill Lynch. Pat, how you doing?
Charlie, always good to be with you.
Good to be with you, my friend. And we got our special guest, Mark Mulholland of Matthew 25 Fund, and he's had a terrific track record for a long time. Of course, we have to tell you that doesn't guarantee future results. But Mark, I know you keep trying your best and you're doing well, buddy. Okay. Good to see you. Thanks for being here.
Hey, Pat. Good to see you, Mark.
Okay, we're going to just do a round robin tonight instead of our other format. So let's start out by talking a little bit about home prices and opportunities in that sector. If you look around the country, it's bifurcated. You know, places like California, New York, prices are ridiculous. Other places, nothing's happening. So I guess I have two questions. What do you think about home builders, and what do you think about home improvement stocks?
I love them. I can't figure out why they haven't done better yet, because all the writings on the wall, this looks like the market. We worked off the inventory. You can see construction popping up. Price, every quarter comes out for the two we own, are D.R. Horton and Cal-Atlantic, which was a merger, and O'Reilly, which was one we owned before. But they're cheap. They're great. I have them about 7.5% of the fund, and they actually did well today, but they haven't done anywhere near what I think they will over the next 3 to 5 years. So.
Okay, how about home improvement? People spending their money
I think
to
they're
fix
solid.
up the house they're in,
But they're not as cheap.
Yeah.
And so, because I did look at that, I looked at, I think it was Lowe's or Home Depot had a good earnings announcement. I went and looked at them, and I forget the exact numbers, but they were fairly priced. It wasn't, which kind of like, we'll talk about that a little bit later, is it folds in. I find a whole bunch of stocks in the market that are fairly priced. They're just not overpriced. And, I'm looking for things that are cheap and growing is where I think I make the most money.
Sure.
Yeah, I think the builders they look very attractive here. The numbers that have been coming through have been very solid. And as Mark said, they're very cheap. And I think it's just testing your patience. You have to own them and just wait for them not to be cheap. I think the biggest positive they have, which still I think is the winds at their back, is the just incredibly low interest rate environment we're in. Makes the ability to afford a more expensive home than 5, 7, 10 years ago, right in people's wheelhouse. So I think, the sales will continue to be strong, and I think they're cheap. And
yeah, I think the household formation thing will start being a tailwind instead of a headwind here. All those kids that were 22 when mom and dad put them in the basement, they're starting to get a girlfriend they're serious about, and mom and dad are ready to kick them out of the house. So I think the household formation thing is going to help.
That was like there was a Business Insider had an article. I don't want to get the age wrong, because I always forget where millennials fall in. But if I understood it right, it was like 25 to upper 30s is the lowest percentage of home ownership in years.
Right.
The other thing, which is where this is going to get better, is financing isn't out there. Like I haven't seen the latest numbers, but like June, we're not supposed to date ourselves, but it's a few months past, about 90% of the mortgages were still coming from either Freddie Mac, Fannie Mae, Ginnie Mae, FHA. There was really very, very little financing, and that's what's kind of, when you start seeing that, when you start seeing the aggressive commercials for mortgages, and your banks are sending you little mailers, that's when the financing comes in here. I think you're going to see, some great appreciation, which will help feed, the home building and and the home building stock. So that's an area I have very high hopes for the next few years.
Well, talking about bifurcated markets, let's explore retail for a minute. You have stocks like Walmart, where they gave a minimum wage rise, and then of course the other employees want more money, so now more money is being spent on the employees. The morale still seems to be low. Some of the stores are dirty and people aren't going in them, and the stocks recently was at a 12-month low. Again, I don't want people to time the market based on this, because it is taped, and also we're not accountants and we're not lawyers, so we're just stock advisors, and they should talk to their own advisor before they make decisions. But you've got that side of it, and then you got Amazon just taking over the world, so what's going on? Do you see a stock you like in that sector? Or
yeah, actually, it's funny. Do either of you own Walmart? Is that a stock that you?
I own Walmart, yes.
Yeah.
Well, I looked at it with all the dress, and it's another one of those things. It's like 9.5, 10 times EBITDA. It's not really dirt cheap. Whereas I would like to buy it. I think the guy who's running I think he's heading the right way. He's just got a big ship to turn. But we own a retailer, Cabela's, that had a couple off earnings, a couple quarters off, and that gets a little bit into like gun sales that affects them. And I do think they made some mistakes merchandising in the fall, but that stock got hit. It was down to 4.5 times EBITDA. There's I knew it was cheap, and we had purchased more, and then now there's an activist in there, and he's bid it up. But even now, the stock is still only selling at 12, 13 times next year's earnings, and probably about 6 times EBITDA. It's cheap. It's great. It's a great deal. So, and now I don't worry about them. I know there's a lot of retailers are getting pressured supposedly because of Amazon, but in Cabela's in particular, they're the number one internet for their line, which is basically hunting, fishing equipment, outdoor equipment. They're number one in catalogs, number one in internet, and they're probably 1 or 2, depending with Bass in the store and growing. There's only 1 store in Pennsylvania, and so there's a lot to come to that. So there's a chance they might get bought out. I almost hope they don't. I'll take the money if they do, but I always hope they don't, because I think I'll make a lot more money in the next 5 years on that.
Are you looking at the internet retailing competition and getting nervous about the
I think
the
it's
brick
a
and mortar
very, very
efforts?
challenging time to be a brick and mortar, and the outlook, it's difficult. My 2 favorite retailing stocks, and when I say it, people are like, they look at me funny, but I'll explain it. I think I'm full speed ahead with my 2 favorite retailing stocks, and it's UPS and FedEx, because the numbers are staggering with what's happening with internet commerce. And it's not just Amazon.
Right, FedEx just raised their prices and it looks like it's sticking, huh?
It's just amazing that literally every time you push that button, and it's not just Amazon. You can shop at Macy's online, and you can, anywhere you want to shop, you can shop online, and that's what the new generation wants to do. They don't want to drive and try to fight for a parking spot. Every single one of those boxes has to be delivered by a brown truck or a blue truck.
And the thing that
It's that
amazes me,
simple.
I look at outfits, smart guys like this Pennsylvania Real Estate Investment Trust, and they're putting in a massive place down there in Center City, which has been pretty ugly, and they think they can clean it up and get people. Of course, that's a concentrated area where they figure people only have to walk a few blocks to do their buying, So maybe you can't judge what's going on with shopping centers all over the country, shopping malls, judging by a decision made by somebody like that in an inner city.
Right.
Yeah, plus I think you both hit key points. On that one, location matters. The young are moving to Philadelphia. Apartments are growing, and there isn't great shopping, as there are in some other cities. So I think that's I think what they're trying may not work, but it's very logical.
And rents are going out of sight in Philadelphia, which makes you think that eventually real estate prices have to start moving up. The very high end has moved up. The baseball players buy the stuff and all that, but there's a lot of places in Philadelphia where real estate prices haven't moved much yet.
Remind me to get back to you on that.
All right.
What you said about FedEx and UPS is so spot on. I would love to own Amazon.
Yeah. It's hard, isn't it?
They don't earn much.
It's hard.
And the concept, you hear all these things about especially with the iCloud, they have all this what they're doing. But we own FedEx, and it's not expensive.
Right.
UPS is a little bit more relatively valued, but I figured if they're right about Amazon, I'm going to make a ton of money from that play. On the real estate, one of our holdings, in fact, I drove by coming here, is Brandywine REIT. They own 7 buildings downtown. The stock right now is selling at, if you look at it, treat it like their whole portfolio, at a 7.5% cap rate. They're selling their non-attractive properties, like in suburbs of Jersey, at lower valuations in the 6.
Full disclosure, they own the building where I work in Radnor Financial Center.
Yeah, they're strong, and that's what. And they're building the FMC building on there, and you can literally buy that stock lower than what the buildings. The buildings would probably in Philadelphia now go for somewhere around 5.5 to 6.25 times EBITDA or cap rates, and I know they wouldn't sell them at that price.
Right.
So, but that's what happens. The markets give you, and that's this is why it is a weird market. I can find things that I'm willing to buy till I'm blue in the face.
That brings us to the subject that I really wanted to feature here, is that we've had a big run in the stock market from 2009 till now, and so people are nervous about the market, and we've just talked about a couple of sectors, but are you finding a lot of opportunities even though we've had this huge run in the market?
I have 20 holdings in our fund, and except for MasterCard, which I haven't sold, even though I love the company, but I think it's fully priced, everything else is selling tremendous discount to its private value. On the other side, I'm always searching and researching. Like compared to like 09 was tough because everything was cheap. Then it was almost getting to be like, it was like a kid in a candy store. You had to really narrow it down, but it was hard. Here, I feel like our portfolio is almost as attractive as it was in bottom of '09, but everything else is reasonably priced. And my theory is, I think what's happening, and there isn't good data on it yet, because overall there's been net selling of domestic funds, but I believe a lot of money is going into index funds, and we're getting back to the late '90s. So I find a lot of things like, McDonald's and the Home Depots and things like this. They're not overpriced. They're just they're 10, 11, 12 times EBITDA and growing 6, 7, 8%. But so it's a weird market.
Some of these defensive stocks like Procter and Gamble and Colgate, they're up above 20 times earnings,
Yes.
just because
They're expensive.
everybody wants to be safe. And so now they're getting to maybe where they're not as safe as people think they are. What's your thought?
Yeah, no, I think now's the time you have to be more selective than ever, which is really why I think it's real important for people to understand what they own. And full disclosure, actively managed mutual funds have not done well versus the blind indexes for many years now. And I truly think right between our eyes that's about to change, because when you buy an index, you own everything. And so you'll own the good stuff. The problem is you'll own the stuff that you don't want to own. And as Mark said, there's so many things that are really visibly cheap. You want to concentrate and own those things, and there's things that you just don't want to own. And I think the stock picker is going to have a field day. I'll layer one more thing on top of that. The incredible volatility that we're seeing is music to the stock picker's ears.
Absolutely.
I mean, they can buy things that are cheap, and literally, in some cases, not that they want to trade, but we're seeing some moves, 10, 12, 14% in months.
Yeah.
And where appropriate, they'll pull the trigger and take that profit and go and buy something else that's still cheap.
And I think one of the things that a lot of people don't understand with these ETFs is when people start to panic, they start to sell stuff, then that impacts the stocks that are being sold, and the ETFs are driven down. And you look at the mutual fund managers, the problem they have if they're have a big following, when people panic at a bottom, they're getting ready to put their buy orders in, and they're all excited about the opportunity, and here comes liquidation orders at just the wrong time. Whereas if people have separately managed accounts, or they're with a money manager like you, when they want to panic, they can panic if they want to, but they're not going to affect other investors. It's their set of stocks, right, that they're selling.
Well, I'm in that where you have the stress from that. I don't have, separately managed accounts.
Okay.
I just run to one fund. And
all right.
There's the one thing that's tough is you get these redemptions, and it does. It's a negative because it'll cause you to take, in this environment, because the prices aren't down that much. We'll end up taking some gains, which is a little bit of a negative, but there's actually a tax advantage that funds get on that, which I can explain if you want to know. But the positive side to that is it makes you so much more efficient in your portfolio. Like, at first you get rid of the things that you like, but not quite sure, small holdings, stuff like this, they're all gone. Then you get to your core stocks, and even with that, like, we mentioned a couple companies that I've been adding to even in this squeeze, and you get these portfolios. So if anything, we're probably getting a little bit more concentrated. But I feel better about our portfolio than I have in years. And I was telling you guys beforehand, I've put more money in the market, new money, not trading within the fund. I'm talking about my own personal money, than in any other year. Because
it gets to the point where you have to get rid of your 10th favorite child.
Yeah.
Well, that's what happened.
I love all my children.
I joked with one of the directors. I'm like, I got rid of the ones that are little headaches, or like what we call it. But now I'm like, if I had to sell something, everything I'm selling, I love. Like, I know I'm leaving money, I'm giving money away. Right. But you do what you have to do.
Pat, I think where you and I can provide a lot of added value for people, as opposed to people that are with some outfit that they don't have help from a financial advisor. When they're wanting to panic, you'll wrestle them to the ground on a 1,000-point down day in an August, and say, we're not selling anything today, and drive over here and argue with me and I'll buy you lunch, but we're not selling, and then you get a Christmas card from them for 10 years because they didn't sell on that real ugly day where they wanted to panic, right?
Let me give full disclosure to
Absolutely.
I think you guys are good, and you're positive, and you're optimist, and you're a true capitalist. I know a lot of separate, brokers or separately managed RIA, and I think they're terrible. I think they get lulled into all the volatility. Like you had said something earlier, Pat, volatility is not a risk. It is absolutely
can be great news.
A buying opportunity for a long-term bull.
Right.
But some people, I think there are other brokers that scare their clients.
Yeah.
So it's not like, there's a bell curve of brokers. I think, advisors. I think you guys are good. It's one of the reasons I like doing the show with you. And, but there are people that get spooked by these people.
Yeah.
So.
August 24th, where I saw that what the futures were doing, I was so happy we got some managed money. We threw in some orders at the opening there, and by the end of that week, we were down 1,000 at the opening. By the end of that week, we had recovered all of that 1,000 plus 250 points.
Correct.
It was a great time to buy, but unfortunately, a lot of people want to sell at a time like that.
And that's the best way to do it. It's to have separately managed accounts, but have some discretion, because the call people, most people innately are not going to buy on weakness.
Yeah.
And yet, it's a great way to make some money.
Let's take a time out and try to help one of our viewers. Richard Marks from Ardmore says, when interest rates go up, should you get out of bonds? You're the guy I'm going to ask the question to because he's a stock guy.
It really all depends, but I think going back to what you just said, the critical question is, well, what are they? When you say I own bonds, what do I own? And what I'm getting at is, I would tell you, I think this is a very dangerous time to own bond mutual funds.
Yeah.
If I own the individual bonds in a separately managed account, sure, if rates go up, my bond prices will decline, but I can choose to sit and own it until maturity.
Sure.
So in that environment, if I own it for the right reasons, I'm fine owning those bonds and not doing anything. In the mutual fund side, what you pointed out is very, very true. If bond prices get hit hard because rates spike or people think rates are going to spike, and my next door neighbor panics and sells his bond fund that I also own, that's a permanent loss of my capital. Even though I didn't do anything wrong, his or her bad behavior cost me money. So I think the answer to the question is depends what you own.
Good answer. And I want to add to that if you're in short to intermediate term stuff, you're not making much return, but you're not going to hit hard. Quick story, before I got in the investment business, but I like the markets, way back in 1979, my wife's girlfriend had gotten a divorce, and the guy put her in $120,000 worth of 30-year bonds. And then interest rates went from 8% to 16%. And she came over to see me in tears and said, Charlie, I decided I don't like what I'm hearing, and I want to just get my money back. And I said, no, you don't understand. You now own $60,000 worth of stocks, not 120, because of that change. Because you can think of it as infinity at the 30-year bond. And I said, just keep clipping your 8% coupon.
Right.
Be disappointed you didn't get 16%, but it'll come back and you'll get 8%, and I still get Christmas cards from her.
Absolutely.
But the point is that if we do have, and when you have mutual funds, when you have tax-free mutual funds that are showing you they're paying 4 or 5%, and when you have a government bond fund that's way out there on maturity that's paying less, there's something wrong with that picture. And people that own nothing but long-term treasury bonds that are out there 10, 15, 20 years, they better be careful, because there's got to be a reversion there. The tax-frees that are safe shouldn't be paying more in absolute numbers than the taxable
and
bonds.
In some cases, a lot more.
Yeah.
It doesn't make sense.
That is the one apparition or variance that doesn't make sense. Munis, there was an issue with the munis at first because of the municipal insurance companies, but they're fine. Even the worst one, AMPAC, hasn't missed a payment on any defaulted or protracted payment type of bonds. But everything, it's there. That's one area that's not terrible. But I was looking at
one second, Richard. I hope you enjoyed our answer, and I want to get our viewers a chance to send in some questions. So here's a tape to show you how to do it.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
So I interrupted you while we were putting out our advertisement for some more mail. So you want to continue the thought, or we want to move on?
Well, just his question, I would say, Richard asked, when interest rates go up, you get out of bonds. No, you want to get out before they go up.
Yeah, right. And the guy that knows how to do that is very, very wealthy.
I know.
Yeah. All right. So, let's talk about what sectors, what type of stocks you like. Do you care if something's a small cap or a mid cap or a large cap? What do you look for?
No, I'm actually, I've always been cap neutral. I think that what I liked, I did just put a little data together before we came here. I always find, I like value and I like growth and value. I'm not great on that's one in Amazon, like a growth that's way up there and stuff, so forth. For me, I think you make the most money. I don't care if they're raising rates, lowering rates. I don't care if it's a recession. I don't care if it's, when you can get growth at a reasonable price, you're going to make money if you're a long-term investor. So I took we have roughly 20 some stocks in our portfolio. 15 fall into what I consider growth and value. And for real quick terms, the PEG ratio is basically taking the price to earnings divided by the growth rate. And, to give you a rough rule of thumb, the market, say, averages 15, 16 PE and grows 6, 7%. So anything, 2.25 is kind of like a market average. But we have our portfolio, not weighted, I just took the straight average, is right at the end of the market now, has a projected 5-year growth rate of 12.1%. We're only at a 1.24 PE ratio, like a 14 PE. So, one's bet is incredible, and Apple's still at that, but a whole bunch of our holdings are very close to that number. And so that's what's weird about this market. I can't find 100 good ideas, but I found enough to make me happy. And, I called one buddy about a month ago, and we were talking, and I just said, look, we're either going to go into recession, which means we're going to make a lot of money in 3 to 5 years, or we don't go into recession, we're going to make a lot of money in 2 to 3 years. I just don't know which one it is.
Yeah.
And so no, I'm optimistic. I told you, I mentioned to you, I've put a lot of money in this year, and I'm not doing it to convince anyone. I'm doing it because I'm a greedy capitalist, and I think we're going to make a lot of money at some point. So.
Aren't those outlawed in the United States? Never mind. We're just moving right along.
Yeah, moving right along.
So, Pat, small and mid caps, how do you pay attention? Do you try to just have a portfolio that's got some of each and then rebalance once in a while, or how do you keep people?
Yeah, the former. I don't really try to guess which sector or which size of the market's going to do best. I like to keep the investors pretty fully diversified, whether it's growth or value. I truthfully don't know which is going to do better next year or the year after that. I just know that over 3 to 5, 10, 20 years, they're both going to do about the same. So I want to own them. But they can have very different moves over shorter periods, so the rebalancing is key.
Sure.
And you want to dot your I's and cross your T's and say, this is what we agreed upon, and this is what we look like now, so we need to make some modifications.
Yeah, and Mark likes the U.S. in general, and that's where he focuses attention, so I'll just direct another one at you.
Yeah.
What do you do about emerging markets and foreign stocks, developing markets? Do you same thing, rebalance? Or?
Same thing, rebalancing off of a general asset allocation model that I like to use. However, I will tell you, I am up at the upper end of my international exposure, developed international.
Yeah.
I have very little exposure to the emerging markets intentionally, but on the developed Europe, Japan, I think these markets are very, very cheap, and with the stimulus that Mario Draghi is convinced and saying he's going to continue to do, longer than it originally, just like we did, I think it will have a positive impact over the shorter time, meaning 1 to 2, 3 years. I think those markets probabilistically will do much better than the U.S., in my opinion.
Thank you. Okay, Mark, why don't you just give us a couple, 3 ideas that appeal to you right now, and just give people a flavor of the kind of stocks you look for.
I'll give you one I love, and I wrote about this pretty fully in my last shareholder letter. Scripps is a company that owns HGTV, the Food Network, DYI, all this good programming. When you talk about themes getting into market, besides the internet theme with Amazon, there's a theme with Netscape is going to destroy every other media company out there and dominate the world. Netflix.
Netflix.
Right.
Yeah.
Maybe it'll be like Netscape at some point. But Netflix is a good concept, but they need content. They do some of their own programming. So this company went through had an attempted takeover, got up in the 80s. It sells in the mid 50s, got down in the high 40s recently. 6.5 times EBITDA. It's probably about 13 times earnings. Virtually no debt, which is rare for a media company. It's a steal. And I think, and it's still like something that's expected to grow 10% a year. Polaris, we mentioned, we've owned Polaris since 1998. I know we're not supposed to date ourselves, but I can say it's 2015, so you can figure out, it's been, 17 years. It's about as good a buy as I've ever seen it right now. It's extremely well run. I mean, this is a company that went from, I wrote in a shareholder's letter, I pointed out, they went from about $1 billion in sales 10 years ago, about 25, roughly 25 million in debt, about 5 million shares outstanding. They do $5 billion in sales. They have less shares outstanding. They're actually net positive on cash. You can buy that stock at roughly about 14 PE, 7.1 times EBITDA, 16% grower. It's just I love these things. That's why this market's weird. I'm not like a kid in a candy store, but I've added some things. I've really added to some of our portfolio, and I'm about as positive as I've ever been about what I'm buying. I just don't know when it'll go up. At some point it will.
Okay. How about yourself, Charlie? What do you like right now? In the
well,
marketplace?
actually, I'm getting ready. I think that people are getting so upset about emerging markets. I'm getting ready to maybe shift a little money into that. We have an international allocation, and like you, we've been mostly in the developed markets.
Right.
So I'm thinking that might be a place now that everybody is really sick of even the thought of owning an emerging market stock or mutual fund. I think I may get ready to make a move there. And the other thing is, I'm thinking about the municipal bonds. If we have a run where we get up to 20 PEs for the average stock here in January because the hedge funds are buying to get an extra payday, and I don't want to get into that, but if we do, then I may be actually shifting some money over into municipal bonds, because those 65-year-old clients in the year 2000 that I shifted way over into the stock market are now 80.
Yeah.
And I'm a little uneasy having them 84% in the stock market. It's worked out well, but at a certain point you say, let's keep what we got.
Let's call a timeout.
And Charlie, when do you do actual bonds, or would you do a muni bond?
Yeah, I'll use somebody that knows what they're doing. Somebody like a Nuveen or whatever to buy an intermediate bond ladder or something like that.
Okay.
Or let them pick the bonds. And sometimes they buy these bonds that are priced above par, but they know how to play that cycle and get rid of them before they start to drop back off. And I'm not good at that. I mean, I want experts to handle each part of the investment portfolio that we have. So in the remaining minute or so, do you ever raise cash, or do you just try to stay 100% fully invested?
I don't try it. It's just that but the one problem is, like, I remember when Peter Lynch retired, he had talked about it. He goes, if you look at 100 stocks, I'll find one good idea, and that's what's different about now. 5 years ago, if I looked at 100 stocks, I found 60 good ideas or 70. Now I look at 100 stocks, I find 3. If I don't find any, I'll stop. But I don't like force it. There's a lot of great buys out there right now. It's weird. It's not broad based, but it's there's things to make money on, and if I can't find anything to make money on, I hope I would stop and send money back.
Well, I appreciate you guys giving our viewers and listeners some great ideas. And the way I see it, people had a chance to realize that this is not a game for the uninformed or the people that don't pay full attention to the market. So they should be thinking about a guy like you, especially at a time like this. We appreciate you being here. And
Thanks,
Pat, it's always fun doing the show with you.
Terrific.
So next week, we're going to have Mark Izzo of Converge Solutions. It's an HR firm, and there's a lot of aspects to human resource management, so we hope you'll join us. It's going to be an interesting show. As far as we're concerned, your money matters.